just when landlords thought they had seen it all. There are fresh rumours suggesting that landlords may be hit with a fresh wave of taxes. National insurance on rental income, stamp duty reform, and even there might be buried costs in the next budget coming. Now, it does seem that a very specific type of landlord is being targeted. Is this by design or just because this type of landlord is an easy target? In this video, I'm going to break down the latest tax rumours and what they mean for the bottom line. The tax changes that we've seen in the last decade and how it's reshaped the rental market, but also why so many landlords in the buy-to-let industry are rushing to set up limited companies. Now, this is a video you may want to watch because the stats may shock you. Stick around. One of the biggest rumours we're seeing right now is that the government may extend national insurance contribution to rental income. So right now, as it is, landlords don't pay national insurance on their rental profits, but that may change. So when we look at employees pay around about 12%. These are on earnings between 12,000 roughly to around 50,000 and 2% above that. Now, when it comes to self-employed, and a lot of landlords are self-employed, you're looking around about 9% and then 2% above that £50,000 threshold. If this changes, landlords can suddenly face between 8 to 10% extra tax hit on their rental income. Let me give you a few examples. Start with John, a small landlord. Now, if John made £10,000 in net profit on his rental income, currently John is going to pay around about £2,000. That's a 20% tax. However, if this is implemented, John may face around about 8% if they put it at that rate, and an extra £800 gone. Here's another example, Maria, a mid-level landlady. With £25,000 net profit at 40% income tax, she will already pay £10,000 and national insurance at 8%, £2,000 extra, taking her total tax bill to £12,000, almost half her rental profit. And let's take James, a professional landlord, earning £50,000 profit and will pay £20,000 on national income tax. That's at 40%. Now, with national insurance at 8%, that's an extra £4,000, making it a total of £24,000 on a £50,000 profit. So, that is effectively 48% tax. Now, that is why so many landlords are worried, because it's going to impact their bottom line. So, at a stroke of the Chancellor's pen, your bottom line may be impacted hugely. Current proposals have suggested that stamp duty on primary residencies could be abolished. Good news? Well, not quite. It has been proposed that it will be replaced by property tax, charged annually based on the value of the property. Now, they are going to be specifically targeting properties above £500,000, if we are to believe the rumours, of course. And that's on a sliding scale between 0.5% to 0.8%. The proposal is being suggested as a way of removing that stamp duty hurdle. As an example, first-time buyers, they've got to save up for years, at least most of them, for a deposit. That's of course if they don't have mum and dad bank. They also have to struggle, a lot of them, with mortgage affordability. Then on top of that, they have this tax that they're hit with. And this, in some way, will encourage market activity. And the comments here include, it is argued that stamp duty stifles market activity as a tax on trading. This makes the property market less fluid than it might otherwise be. A new property tax on primary properties could potentially remove barriers to entry and encourage stakeholders to engage with the market more readily. And if you're finding this video helpful, make sure you smash that like button. It really does motivate me in making more of these videos. Here's an idea. How about removing stamp duty and this property tax altogether? Removing all type of barriers. Because ultimately people see this as a tax on moving. And instead of moving it from one side, the buyer, to the seller, perhaps this will actually engage and encourage market activity, where a lot of people who are looking to sell right now are actually on hold because they don't want to be hit with that tax. Stamp duty already accounts for £14 billion in Treasury revenue between 23 and 24. And landlords make up a big share of this with those increased rates in stamp duty. So landlords are going to be the obvious target for the Chancellor. However, if we look at the market impact, Hamptons does share with us that this has had an impact with regards to taxes and the costs that landlords are facing, has an impact already. In fact, if we look at transactions are 11% in 23 from landlords and investors. That's a drop from 15% in previous years. So we're already seeing an impact, and this is only going to push investors and landlords to either delay or sell up. And of course, that's going to have an impact on the rental market, which we're already seeing a shortage of rental properties. And this wouldn't be the first time that tax changes have reshaped the buy-to-let sector. In 2016, we saw the Chancellor, George Osborne, announce the stamp duty surcharge for additional homes. Now, suddenly, a property of £300,000 had a 3% surcharge, bringing it to an extra £9,000 in tax. In 2021, the surcharge increased for overseas buyers. Now, we also saw Section 24 being implemented and phased in between 2017 and 2020. Now, what that meant was that landlords can no longer deduct their mortgage interest in full as an expense. And that was a major issue, especially for those landlords who are on higher tax bands. Suddenly, they saw their tax bill double. The NRLA estimates that around about 500,000 landlords saw their tax bill go up with Section 24. And whilst interest rates can still be deducted if you're an incorporated landlord, those rates have gone up. In fact, if we look at incorporation tax, increased between 19% and 25% in 2023. And the fact that we're seeing tax changes consistently in the UK absolutely means you should subscribe to this channel so you could keep up to date. In response, many landlords are incorporating. Why? Well, as an incorporated landlord, you can still deduct mortgage interest as an expense for your business. And your profits are taxed through corporation tax, not income tax. The trend, well, Companies House have reported that we've had an all-time high of landlords and buy-to-let investors incorporating. In fact, in 2023, that was 47,000 companies set up for buy-to-let. That's an all-time record high. That means over 300,000 active landlords companies across the country. Here's the bigger picture. Landlords are being squeezed from every direction. Taxes, regulations, and now rumours of even more taxes. And when it comes to available homes, well, landlords provided around about 20% of homes in England alone. This was back in 2017. Fast forward to 2024, that's come down to 17%. Now, the other end of this is that Rightmove has also shared data saying that properties outside of London have increased by around 33% in rental. I know that to be more than that in certain parts of London. So it's having a real impact on the rental market. So what happens if these rumours are true? Well, more landlords will exit, meaning that rental prices will increase, and the power will shift from small landlords into incorporated professional landlords and even those large corporates who are doing build to rent. Now, I'm interested in how you feel about that, whether as a landlord or a tenant. Leave me a comment below. Here's my take on this. The direction of travel is clear. Those smaller casual landlords are being regulated and taxed down. The professional and incorporated landlords are the future. And if you're a landlord today, well, here's some tips. First off, make sure you stay ahead of the rumours, because sometimes they do become reality. Run the numbers on incorporation with an accountant and a tax expert. Budget accordingly, because one thing's for certain. Those who adapt not only survive, they thrive, and those who bury their head in the sand won't. And if you want to find out the 10 policies that will kill UK property in 2025, make sure you watch my next video, also in the description below.